You know, everyone is always hunting for that secret to trading, that one perfect strategy, that magic indicator that's going to make them rich. But what if I told you the real secret isn't about how you find the winners, it's all about how you manage the losers? So let's get into the one skill that truly separates the pros from everyone else: risk management.
First things first, a quick reality check. Studies show this pretty shocking statistic consistently. Up to 90%, 90, of retail traders lose money, and, well, they eventually quit. That's an absolutely staggering number when you think about it.
So, the obvious question is, why? I mean, are 90% of people just terrible at picking stocks? Not really, no. The answer is actually a lot simpler and way more important. It's not about the strategy, it's about the math.
And that brings us to what I call trading's brutal math. See, most people are focused completely on offense. How much money can I make? But the pros, they know that long-term survival and real profit is all about playing defense first. Okay, here's a core truth that our brains just aren't wired to get right away. Imagine you have 10,000 rupees and you lose 50%. You're down to 5,000, right? Now, to get back to where you started, back to that 10,000, you don't need a 50% gain. You need to double your money. That's a 100% gain. And you can see that gap so clearly here. The hole you dig is always, always harder to climb out of. This imbalance, this asymmetry between losses and the gains you need to recover, that is the #1 reason so many trading accounts get wiped out. Oh, and trust me, it gets so much worse. A 70% drawdown, which, by the way, can happen with just a few bad, oversized trades, means you now need to more than triple your remaining capital just to break even. Look at that. A 70% loss creates a mountain that is almost impossible to climb. This all leads to one single crucial point. Your most important job as a trader is to avoid large losses. Period. Full stop. Okay, so how do we do that? How do we avoid these massive, account-killing losses? It's not with hope or gut feelings. It's with rules. We have to build a personal, non-negotiable system that protects our capital. This is the moment we stop gambling and start running a business. So let's start with the absolute cornerstone concept: risk per trade. Before you even think about how much you could make, you have to decide on the absolute maximum percentage of your total account that you are willing to lose if this one idea goes wrong. And you make this decision when you're calm, objective, not in the heat of the moment. So what's the magic number? Well, for professional traders, it's typically between 1 and 2%. And for beginners, starting at just 0.5% is even smarter. Now, why so small? Simple. It guarantees your survival. Think about it. With a 1% risk rule, you would literally have to have 100 losing trades in a row to wipe out your account. That's your defense.
And you can do this math right now. Just take your total account balance and multiply it by your chosen risk percentage. So, if you've got a 10 lakh rupee account and you're using that 1% rule, you have just decided that no single trade ever can lose you more than 10,000 rupees. All right, so knowing your max loss in rupees is step one. But how do you actually enforce that? Well, let's move on to what is, without a doubt, the single most important calculation any trader makes before they even think about hitting the buy button, and that's position sizing. And look, this isn't some complex calculus. It's a really simple 3-step process. First, you know your max risk in rupees, right? We just did that. Second, you figure out your risk on a per-share basis. That's just the difference between where you're getting in and where you're getting out. If you're wrong, your stop loss. Then finally, you just divide step 1 by step 2. This one formula, this is what connects your big picture risk rule to your actual trade. It mathematically forces you to stick to your plan, and it completely removes that emotional guesswork of, how many shares should I buy? Let's just walk through a quick example to make this crystal clear. Let's say you have a 25 lakh account and a 1% risk rule. So your max loss is 25,000 rupees. You want to buy a stock at 100 and you decide your I'm wrong price, your stop loss, is at 95. So that's a 5 rupee risk per share. You just divide 25,000 by 5 and there's your answer. The correct position size is 500 shares. No more, no less. Okay, so now we know how to control our risk on every single trade. Let's talk about the 2 essential tools that actually make this whole system profitable in the long run. We're talking about the stop loss and the risk-reward ratio.
So the risk-reward ratio, or RRR, this is basically your offensive strategy. It asks a simple question. For the amount I'm risking, is the potential reward big enough to even be worth my time and capital? Pros almost never take a trade unless the potential profit is at least twice the potential loss. They're always trying to risk 1 rupee to make 2 or 3 or even more.
And this right here, this is how you get your edge in the market. Look at this. If you only risk 1 rupee to make 2, you only have to be right about 1/3 of the time just to break even. If you aim for 1 to 3, you can be wrong 75% of the time and still not lose money. This is how you become a profitable trader without having a crystal ball.
Of course, none of this works without the single, golden, non-negotiable rule: always use a stop loss. It's the mechanical trigger for your risk plan. The best way to think about it is like a seatbelt. I mean, you wouldn't drive a car without one, right? So don't you dare enter a trade without one. It's what saves you from a catastrophic accident.
All right, we have the math, we have the rules, and we have the tools. But the final piece of this whole puzzle is probably the hardest one, and that's discipline. The goal is to shift your focus from the profit and loss of any one trade, and instead focus on flawlessly executing your system. And to help with that, use a simple pre-trade checklist. Before every single trade, you just mechanically go down the list. Is my risk defined? Yep. Is my size correct? Check. Is my stop set? Yes. Is the reward worth the risk? Yes. Am I calm and thinking clearly? Yep. If the answer to any of those is no, you just don't take the trade. It's as simple as that.
And this all brings us to a final, really important point. Everyone's looking for excitement in the markets, right? But professional trading isn't about excitement. Real risk management, it's boring. It's mechanical. It's repetitive. It's doing the same simple calculations and following the same rules day in and day out. And that is its superpower. That is precisely why it works.
So I'll leave you with this one question to think about. When you place a trade, are you running a business? Are you following a well-defined business plan that's designed for long-term survival and profit? Or are you just pulling the handle on a slot machine hoping to hit the jackpot? The choice, and ultimately the outcome, is entirely up to you.